What if I told you the greatest investor of all time, Warren Buffett, calls this book the best ever written on investing? I'm talking about The Intelligent Investor by Benjamin Graham, first published in 1949. It's not a get-rich-quick guide. It's about building wealth safely and intelligently. In the next 10 minutes, I'll break down the timeless lessons from this investing Bible. The first lesson is knowing the difference between an investor and a speculator. An investor buys stocks as part of a long-term strategy, looking at the underlying business. A speculator treats stocks like lottery tickets, hoping for short-term price swings. Graham warns, if you don't know which one you are, you're probably speculating. Takeaway: if you want lasting wealth, think like an investor, focus on value. Next comes Graham's most famous metaphor, Mr. Market. Imagine you have a business partner called Mr. Market. Every day, he offers to buy or sell shares. Some days he's euphoric, offering crazy high prices. Other days he's depressed. The intelligent investor doesn't follow Mr. Market's mood. Instead, they take advantage of it. Lesson: the stock market is there to serve you, not instruct you. Perhaps Graham's most important idea is the margin of safety. When you buy an investment, it should only be if it's worth more than what you're paying. The gap between price and value is your safety margin. For example, if you believe a company is worth $100 a share, buy at $70 or $80. This principle protects you from big losses and gives your portfolio resilience. Takeaway: never invest without a margin of safety. Graham divides investors into two types, defensive and enterprising. A defensive investor wants a hands-off, low-risk strategy. They should focus on diversifying, low-cost index funds or blue-chip stocks. An enterprising investor is willing to put in time to research undervalued companies. Both approaches can work, but you need to honestly know your temperament. Graham emphasizes balance. A portfolio should not be 100% in stocks. His classic advice: keep somewhere between 25% and 75% in bonds. Why? Because bonds provide stability and income when stocks become volatile. Combine this with broad diversification in equities, and you create a portfolio that can weather market storms. Finally, Graham says the hardest part of investing isn't financial, it's emotional. Markets will crash. Stocks you love will fall. The news will scream panic. The intelligent investor remains calm, rational, and disciplined. Remember, the greatest risk to your portfolio isn't the market. It's your own behavior. So, what have we learned from the intelligent investor? Be an investor, not a speculator. Take advantage of Mr. Market's mood swings. Always insist on a margin of safety. Choose a defensive or enterprising approach based on who you are. Balance stocks with bonds and diversify. Master your emotions, because discipline beats panic every time. This is why Warren Buffett still recommends this book decades later. If you found these lessons useful, hit subscribe and join me for more book bites, where we turn the world's best books into practical insights you can use today.